What if leaving California doesn't actually mean you're free from it anymore? Reports suggest thousands of people who moved out are still facing unexpected tax questions, audits, and financial pressure. Some experts warn that starting May 1, 2026, new rules could make it even harder to truly escape the system. It sounds unbelievable, but for many, it's already becoming a stressful reality. Imagine packing your life, moving to a cheaper state, thinking you've finally saved your income, only to receive notices asking where your money came from and why California still has a claim. With remote work, digital income tracking, and tighter residency rules. And most people don't even realize the risks until it's too late. In this video, we break down 10 shocking reasons why this situation is creating fear and urgency, and what you must do right now to protect yourself before the deadline hits. Number 1. The exit tax shock. Most people believe that once they leave California, their tax obligations end instantly. But here's where things get complicated, and even a little alarming. Experts often point out that leaving a high-tax state doesn't automatically cut all financial ties. In fact, under certain conditions, authorities may still question your residency status, especially if there are signs that your connection to the state never fully ended. This is what many are calling the exit tax effect, not always a direct tax, but a situation where your financial activity, assets, or timing of your move could still fall under scrutiny. For example, if you move right before selling a business, cashing out investments, or receiving a large payout, it may raise red flags. Authorities could argue that the income was actually earned while you were still connected to California, which means you might still be liable. Research in tax policy shows that states are increasingly focusing on high-value exits, especially in a world where people can move quickly but keep financial ties behind. Things like owning property, maintaining bank accounts, or even spending extended time in California after your move can create complications. So what can you actually do? The key is clear and complete separation. That means documenting your move properly. New lease, new driver's license, updated address on all accounts, and ideally, shifting your daily life completely. Even small details matter, like where your primary doctor is or where your family lives. Ask yourself, have you truly left, or are you still partially connected? Because in this new environment, that difference could cost you far more than you expect. What do you think? Can you really escape a system like this, or is it getting harder every year? Drop your thoughts below. We put serious effort into uncovering these hidden risks, so don't forget to subscribe. It's just one click, but it keeps you ahead of everyone else. Number 2. Digital tracking of income. Here's where things start to feel even more intense. In today's world, almost every financial move you make leaves a digital footprint. From online payments to remote work platforms, your income is no longer tied to just one physical location. And this is exactly why many experts believe tracking income across states has become easier than ever before. Think about it. If you're working remotely for a California-based company, receiving payments through digital platforms, or managing online businesses, your earnings can still appear connected to California systems. Advanced data sharing tools and reporting systems now allow authorities to match income sources, addresses, and transaction histories. This creates a situation where even after moving, your income might still be analyzed under a different lens. Studies in financial monitoring show that governments worldwide are increasingly relying on automated data systems to detect inconsistencies. That means if your declared residency doesn't match your income activity patterns, it could trigger questions. For example, logging into systems from certain locations, using California-based services, or maintaining old financial links can all create confusion about where you truly operate from. So what's the smart move here? It's all about alignment. Your work location, billing address, tax documents, and lifestyle should all point to the same place. Update everything, from employer records to payment platforms. Make sure your digital presence reflects your new reality, not your old one. Ask yourself honestly, does your income story fully match your new location, or are there gaps that could raise questions later? Number 3. The property ownership trap. Here's something most people completely overlook. Just because you leave California doesn't mean your financial footprint leaves with you. And one of the biggest ties that can quietly keep you connected is property ownership. Whether it's a house, an apartment, or even a small rental unit, owning property in California can continue linking you back in ways you might not expect. Imagine this. You move to another state, thinking you've started fresh, but you decide to keep your California home as a rental. Sounds smart, right? Passive income, long-term investment, but here's the catch. That property still generates income inside California, and that alone can keep you within the state's financial radar. In some cases, it may even raise questions about whether you've truly left or just partially relocated. Research around state tax behavior shows that property is often used as a strong indicator of ongoing ties. If you still own a primary residence, frequently visit it, or leave it available for personal use, it can suggest that your life is still centered there. Even small details, like where your mail is sent or how often you stay in the property, can start to build a bigger picture. So what's the practical move? You need a clear strategy. Some people choose to sell before leaving, cutting all ties completely. Others convert their property strictly into a rental with proper documentation and minimal personal use. The key is to avoid any gray areas. Ask yourself, is your property helping your future, or quietly pulling you back into a system you thought you escaped? Number 4. High-income targeting. Now let's talk about something that many people don't realize until it's too late. Not everyone is treated the same when it comes to enforcement. If you're earning higher income, running a business, or planning a major financial move, you may attract far more attention than the average person. And this is where things can become very serious. Studies in tax enforcement patterns show that authorities often focus on high-value individuals, especially during major life changes like relocation.
Why?
Because that's when large amounts of money are in motion, selling assets, cashing out investments, receiving bonuses, or closing business deals. If these events happen close to the time you leave, it can raise one big question. Was that income truly earned after you moved, or before? Imagine planning your move perfectly, but just weeks later you receive a massive payout, maybe from stocks, crypto, or a business exit. On paper, it looks like you earned it after leaving. But if there's any indication that the groundwork was laid while you were still in California, it could lead to deeper review. And once that happens, things can escalate quickly. So what's the smart strategy here? Timing is everything. Many experts suggest planning your income events carefully, ensuring there's a clear gap between when you leave and when you receive large financial gains. Documentation becomes critical: contracts, timelines, and proof of when decisions were finalized. Ask yourself this: are you moving at the right time, or could your biggest earnings accidentally pull you back into the system? Number 5. Residency audits are rising. This is where things become even more intense, because it's not just about rules anymore, it's about verification. More people are reporting increased scrutiny after they move, and one of the biggest tools being used is something called a residency audit. In simple terms, this means authorities take a deep look into your life to determine where you actually live, not just where you claim to live. And here's the surprising part: it's not based on just one factor. It's a full picture analysis. Things like where you spend most of your time, where your bank transactions happen, where your phone is active, even where your daily habits are centered, all of this can be considered. If your lifestyle doesn't fully match your declared move, it can raise serious questions. Research into audit patterns shows that these checks often focus on inconsistencies. For example, if you say you've moved, but your spending patterns, travel records, or even medical visits still point heavily toward California, it creates doubt. And once that doubt starts, the process can become long, stressful, and financially risky. So what's the smart move? You need consistency everywhere. Your address, your bills, your routines, everything should clearly reflect your new location. Even small things matter, like where you vote, where your car is registered, and where your primary services are based. Ask yourself honestly, does your daily life fully support your new location, or are there small details that could raise big questions later? Number 6. Remote work complications. This is one of the biggest reasons people get caught off guard. Remote work has changed everything. In the past, your job location clearly defined where you paid taxes. But today, you can live in one state, work for a company in another, and get paid through systems that blur the lines completely. And that's exactly where complications begin. Imagine this: you move out of California, settle into a new state, and continue working for the same company remotely. Everything feels normal. You've changed your address, updated your documents, and started a new life. But behind the scenes, your income is still tied to a California-based employer. That connection alone can raise questions about where your work is truly performed. Experts often point out that remote work creates gray areas in tax interpretation. If your employer is in California, if your contracts were signed there, or if your work activities are still linked to that system, it may complicate your situation. Some studies in modern workforce trends show that governments are still catching up with remote work laws, which means enforcement can vary, and that uncertainty is risky. So what should you do? Clarity is everything. Make sure your employer officially records your new work location, updates payroll systems, and reflects your new residency in all documents. If possible, get written confirmation that your work is considered outside California jurisdiction. Ask yourself, is your job truly based where you live now, or is it still quietly connected to where you came from? If you work remotely, this could affect you the most. So tell us, where is your job really based? Comment below. We break down complex topics like this for you, so don't forget to subscribe. It's just one click that keeps you ahead of the curve. Number 7. Business ownership risks. This is where things can get even more serious, especially if you own a business. Many people believe they can simply move out of California and leave everything behind. But if your business is still connected to the state, your financial ties may still remain active, even if you're physically gone. Let's say you own a company that was registered in California, or you still have clients, operations, or employees based there. Even if you relocate, that business activity can continue linking you back. In some cases, authorities may view your income as still being generated within California, which could raise questions about your tax obligations. Research into business taxation shows that states often look at where value is created, not just where the owner lives. If your company operates, earns revenue, or maintains a presence in California, it may still fall under certain rules. This includes online businesses too, because digital services, client bases, and transaction flows can all be tracked and analyzed. Now imagine this scenario. You move out, but your company continues running as usual in California. You're earning income, managing operations remotely, and thinking everything is fine. But legally, that ongoing connection could still bring you into the system you thought you left. So what's the smart move? You need to restructure carefully. This could mean relocating your business, changing its registration, or shifting operations to your new state. The key is to reduce or completely remove any strong ties that keep pulling you back. Ask yourself, is your business truly moving with you, or is it silently anchoring you to your old state? Number 8. Investment income exposure. This is another hidden layer that many people completely underestimate. Your investments don't move as easily as you do. Even if you physically relocate, your financial assets may still be tied to systems, institutions, or timelines connected to California. And that's where the risk begins. Think about stocks, crypto, dividends, or even rental income. These earnings don't just appear out of nowhere. They're linked to accounts, platforms, and sometimes decisions made while you were still living in California. If you suddenly receive large gains shortly after moving, it can raise a critical question. When was this income actually generated? Financial research shows that authorities are increasingly paying attention to capital gains timing. If an investment grew in value while you were still in California, but you sell it right after leaving, there could be scrutiny over whether that gain is still partially connected to your previous residency. The same goes for crypto trades, stock liquidations, or business-related investments that cross state lines. Now imagine this scenario. You move out, thinking you've optimized your finances, then decide to cash out a major investment. It feels like a smart move, but without proper planning, it might trigger questions you never expected. So what's the smart approach? It's all about planning ahead. Review your portfolio before relocating. Decide whether to sell, hold, or restructure your investments based on timing. And most importantly, keep clear documentation showing when decisions were made and where you were officially residing. Ask yourself, are your investments aligned with your move, or could they create a financial trail that leads right back? Number 9. Family lifestyle connections. Here's something that surprises a lot of people. Moving your address is one thing, but moving your entire life is something completely different. And when it comes to determining where you truly belong, authorities often look beyond documents and focus on your real-world connections. Think about your daily life. Where does your family live? Where do you spend holidays? Where are your closest relationships, your doctor, your routine activities? These may seem like small, personal details, but together they create a powerful picture of where your life is actually centered. Research into residency evaluations shows that lifestyle factors play a major role in determining your true location. If your spouse, children, or close family remain in California, it could suggest that your main life hasn't fully shifted. Even frequent visits back to California, whether for family, social reasons, or personal convenience, can raise questions about whether your move is truly permanent. Now imagine this scenario. You've officially moved to another state, but your family is still living in California. You visit often, spend weeks there, and maintain strong emotional and daily ties. On paper, you've left, but in reality, your life may still be deeply connected. And that difference can matter more than you think. So what's the smart move? You need alignment between your documents and your lifestyle. That means shifting not just your address, but your habits, routines, and center of life. The stronger your connection to your new location, the clearer your situation becomes. Ask yourself honestly, have you moved your life, or just your location? Number 10. The permanent tax net fear. This is the biggest concern of all, and the reason why so many people are starting to feel uneasy. It's the growing fear that no matter where you go, you might still be financially connected. Some are calling this the permanent tax net, the idea that once you've been deeply tied to a system, it becomes harder and harder to fully disconnect. Now, to be clear, this doesn't mean you're automatically taxed forever. But what's changing is how far-reaching financial oversight can feel in today's world. With digital income, multi-state business operations, and constant data tracking, your financial life is no longer limited by geography the way it used to be. And that shift is creating a new kind of uncertainty. Imagine relocating, setting up a new life, and still feeling like your past financial ties are following you. Old accounts, previous income sources, past investments, all of it forming a trail that can be reviewed, analyzed, and questioned. It's not just about where you live anymore, it's about your entire financial history and activity pattern. Experts in modern tax systems often highlight that enforcement is becoming more data-driven and interconnected, which means clarity and documentation matter more than ever before. The stronger and cleaner your separation, the less room there is for confusion or doubt. So what's the takeaway? Don't rely on assumptions. Plan everything in advance. Make your move clear, structured, and fully supported by documentation. And most importantly, understand that in today's system, partial moves create full risks. Ask yourself, are you fully prepared to disconnect, or could something from your past still pull you back in? Do you think a permanent tax net is real, or just fear? Share your opinion below. We put serious effort into uncovering these realities, so make sure you subscribe. It's one click that keeps you informed and one step ahead. As we reach the end of this breakdown, one thing becomes very clear. This isn't just about moving from one place to another. It's about how your financial identity, lifestyle, and decisions are all connected in ways most people never fully realize. The idea that you can simply pack up, relocate, and instantly disconnect is becoming more complicated in today's world. With the approaching May 1st, 2026 timeline, the sense of urgency is growing. Whether it's your income sources, property, business, or even personal lifestyle, every detail plays a role in how your situation is viewed. Small gaps, overlooked steps, or poor timing can create consequences that follow you longer than expected. And that's exactly why more people are starting to plan their moves more carefully than ever before. But here's the key takeaway. This is not about panic, it's about preparation. The people who stay ahead are the ones who understand the system, organize their transition properly, and make sure every part of their life aligns with their new location. From documentation to timing to daily habits, everything should tell the same story, that you have truly moved on. Take a moment and think about your own situation. If you were to relocate today, would everything match perfectly, or are there hidden connections that could raise questions later? Because in this new environment, clarity is power. And one final thought, if these kinds of rules are evolving here, could they expand elsewhere in the future? That's a question more people are starting to ask. Stay informed, stay prepared, and most importantly, stay one step ahead of changes that could impact your financial future.